Hi, aviation operations students. This is the first of three mini lectures this week on finances. While we're going to mention financials reports a little bit, we are going to leave that to later in the semester and give you some time to work with your budget and think a little bit about money and your business. So let's launch into our presentation. So week 8, mini lecture number 1 on finance, profits, and cash flow. We're going to look at how money moves through your business. So profit, what is it? It's what we all want. We want our business to bring money in. That's kind of the point of the exercise. However, 20% of businesses fail the first year, 30% by the second year, and 50% by the fifth year. However, the other 50% tend to do very well and grow. So you should not expect a profit in the first year or even the first couple years. So I'm going to give you a moment to read this quote on profits. The point of this quote is to remember that in the beginning, to make your company healthy and grow, any profits you have should be invested back into the business to grow it further. When you do that, there's a very good chance you'll have a better payout as the business grows. So when we look at our expenses, we sort them into 2 buckets. Our fixed costs are things that we have to pay for even if we don't have business. We have rent for the hangar. We may have rent or leasing payments for aircraft, even if we don't use them. We may have salaries. Those kinds of things are going to be the same month in, month out. Utilities would vary. So if your business is not real heavy in utilities, so for example, if you have the difference between 10 customers coming in a week and 15 customers coming in a week, is probably not going to change your electric or water bill. So those utilities, even though those numbers are not exactly the same every month, can be budgeted for. You can allocate them for the seasonal variations, but they're still generally a fixed cost. Now, if your business, for example, if you were making batteries and you had to charge those batteries, you would probably have an increased utility bill if you were making more batteries and charging more batteries each month. Then that would go into your variable costs, because your variable costs are dependent on how many units you make. So sales commissions. Again, electricity. In aviation, fuel for aircraft can be another one. So they are paid per quantity produced. Now that may not be linear. It may not be exactly 1 per each item, but it could be for every 10 that you make, you have to open a new box of whatever supplies. So those are your variable costs. So I ask you to think about those costs for your business, because you'll be entering them into your draft budget. Other definitions we need to think about when we're talking about money: reward for risk. Your profit that's left over, the reward for the risks you've taken as an entrepreneur. But again, often in those first few years, you need to put that money back into the business again, but you will often reap a larger profit later on. Return on investment. For each dollar invested, how much did you get back for it? Are you getting as much as you would have if you invested elsewhere? Does it make sense to continue the business? Will that change in the next year? Profit to sales ratio, and that's very simple. You take your income minus your expenses, you divide it by your total sales, and that gives you an idea per unit of what things are costing. And you can do that across different kinds of products or different kinds of product lines. And if you're not getting a really good ratio, you may need to think about whether you either need to change your pricing model, or perhaps that is a line that you want to discontinue. Profit maximization. Again, that can be nonlinear. It can occur in steps. So sometimes you do better by doing less. If you had to buy a whole bunch of supplies to make one more, you have 2 options. It is not to spend the money this month, or since you can make 10 more with that, why don't you go ahead and make 10 more this month, and you don't have to do that again next month. You know, what do you need to do to get the discounted bulk rate? So those are the kinds of things you need to think about in profit maximization. So here's an example on return on investment. Someone invested $1 million in your company. You were able to pay them $200,000 back this year. So they got a 20% return on investment. That's much better than you would see generally anywhere these days. But it doesn't have to be money. It can be things like number of children who got lunch today. There's a lot of metrics that you can use. And in a nonprofit model, you actually use this, looking at what is the cost for me to feed a child. That way, when someone gives me $1,000, I can say, well, you allowed me to feed 30 children all summer long. So you can provide a metric even if it's a non-financial metric. So your objectives: profit maximization. I want to do whatever I can within reason to make that profit as big as it can be. Satisfactory profit. Not more for the sake of more. It's a reasonable amount. It can be modest. And for starting out businesses, that may be a very good goal. Or for some people, because it's part hobby, part business, they're okay as long as they're not having to put more money in it. Non-monetary profit. Again, that could be feeding children. It could be the love of flying. It could be moving an industry forward. But be careful if you're doing this both across a business and a hobby. Consult a tax specialist to make sure that you're not breaking any rules there. And social responsibility. It's socially motivated. It can have a marketing effect. But remember that nonprofits can make profits. They just have to reinvest all the money back into the business or save it for future use by the business. So again, we've talked about how social responsibility, by investing some money, can improve your marketing, may even be able to save you money down the line if you do some green things like put solar in. So for attendance activity 2, this is the slide we're talking about. I would like you and your team, if you have a business team, to get together and think about, for the first year or two of your business, what type of profit objective do you as a team want to accomplish? You can post that along with your draft budget. Some other things to think about: profit levels. What is your profit and how much is enough? FBOs tend to report anywhere from losing money every month to a 25% profit. Profit orientation, having a positive attitude towards profits, being efficient and effective in your use of your tools. And cost control, careful considerations of expenses. Is it necessary this week, or can I wait till next week? Is it going to help us generate income? Is it better to buy in bulk? Be thrifty. Look at it. A lot of businesses, to do just in time, are now buying a lot of things from Amazon Prime. That's not always the cheapest way to go. Is it better for you to go to Costco once a month and load up on cleaning supplies in bulk? If you have the time to spare for that and that saves you money, that may be something you want to do. If, however, taking that hour to go to Costco keeps you from doing something else that generates even more revenue, then maybe it is better to do some kind of a delivery service. Planning, setting goals and tracking your progress is important. So we will be discussing in the next presentation what kind of information system you will use to keep records and track income, expenses, sales, and inventory. Because if you're not tracking those, you will run into problems. And bad debts. How will you define them? How late does a bill have to be before you consider it a bad debt? How will you collect them? Will you call the people yourselves? How much are you willing to threaten them with? Are you willing to pay a debt collection agency to get that money? And at one point, to just write this off and say it is not worth the effort to try and collect the money. Again, money in, money out. Borrowing to ensure a positive bank balance is not an adequate financial survival plan. You need to do more than that. Also, having more coming in than going out does not by itself mean a healthy business. You have to make sure, by following the cash flow, that the income and expenses are balanced in a way that means that your business is growing in a healthy fashion. So just as this aircraft ran out of runway, lack of cash can drive a firm into bankruptcy, even though its products are first rate and its operations are profitable. But the money is not always all there at the right time. Due to the credit economy, cash flow can lag in almost every type of business. You are waiting to get paid while your bills will not wait. The faster a company grows, the greater a need to find a solution for cash flow. Negative cash flow means every month you have less money coming in than is going out. Positive cash flow means that more money is coming in than is going out. That's a good thing, but you also have to look at the timing in coordinating it with bills due. And here's an example. Rent and payroll are due on the 1st. The income comes in throughout the month, So when you look at your monthly balance, it looks like you're doing well. But if you weren't able to pay your bills on time, you could hurt your credit and accrue late fees, which are an unnecessary expense that you can avoid. So I'd like you to consider that for your business as you prepare your draft budget. So planning for a positive cash flow, and you do have to plan. And if the plan is not going the way you want to, are you going to have to sell more? Are you going to have to maybe find another investor? What are you going to have to do to solve that problem? Because you need to pay your bills. What percentage of profit are you trying to build in? Is 15% enough? Large businesses seek 15 to 25% and even more. But that's also not realistic in the first few years. And even in some fields, that may never be realistic. So the first thing you need to do is develop an estimate of expenses and anticipated units sold of each product and service so you can figure out if your idea works. And we call this a draft budget. So we're going to take a quick look at the draft budget. I'm going to stop sharing the presentation and share the draft budget. This is the budget that is uploaded below the homework assignment. In this case, this is a business that I made up called Flight Books. My model is that I sell books. For example, if Summit Aviation is no longer selling books, I take care of that for all of them. I order the books, I place the books, I make sure there's enough there, I make changes as they're needed. So these are the first few things I'm going to start out with, very basic documents, and I'm going to sell them for $5 more than they cost me. Now, whether that's a realistic model or not, I don't know, but that's the assumption I've made for this business. Where this $3,800 comes from is I look down at the bottom. Come on. And I look at my balance. This is basically my checking account balance. And I look at, okay, here it's only $75. So I want to make sure I have about $100 left at the end of the year at the very minimum. So I'm going to need a $3,800 loan. So I'm going to take $3,800 of my money that I had in savings to start this business. With what I sell in that month and the money I start out with, that gives me an income of $4,100. Then we have the fixed expenses. And in my case, I'm paying $50 to display my books at Summit Aviation. I have a second line of a cellular phone, so that's $25. And I have negotiated a $20 set book shipment fee with my provider. Books often can be shipped at a much lower rate. So my fixed costs are $95. It's going to be $95 every month. If I was paying utilities, I might have to fluctuate this seasonally or come up with an average number, knowing that, for example, I might put 150 and it may be 75 some months. And if I'm running air conditioning or heater a lot, it might be $200. In this case, I don't have to worry about utilities. So now for my variable costs, I am going to do some marketing and printing, and I'm going to save up and I'm going to do it kind of at one time. So I'm going to spend this money to make up some flyers and things, maybe do some advertising for starting up my business. And then during the summer, I'm going to arrange to have expenses for the fall as school begins, and I am again ramping up my marketing. I am going to buy QuickBooks and a payroll service. At first, I don't have to do a payroll service, but if I had a payroll service. And then this is what I'm going to sell. And if you look at this formula, an AFM, I'm selling it for 20, I'm buying it for 15, and I'm buying 10 of them. Whoops, a daisy, those numbers aren't updated. Okay, so I will have to fix that spreadsheet. And then I come down here, so that gives me variable costs. I also have fees and dues, so I'm joining some organizations like the Chamber, maybe the AOPA, and I'm going to go to some events. So I budgeted some money, but as I go into winter, there's not going to be as much going on, so I'm not going to put as much money into it then. So that gives me variable costs that run from about $1,800 a month down to $750 a month. And then because I got this investment, I am paying $100 back a month. Or perhaps my father loaned me this money and I'm going to pay him $100 back a month. I'm only paying $1,200 back in the year, but at least I'm making progress. So I have my total expenses, and then I take my income minus my total expenses to come up with my cash short or extra. And then this is my bank balance. So the first month, this is the same. This changes. Now, when I look at this down here, this does meet what I said for the business because I never go below zero. I end the year with $75. But as I look at this model, I'm losing money every month. And this makes sense because I'm ramping up to the big months where I sell. But if I look at this realistically, I probably need to find a second location to sell books by September or October, because it really doesn't make a lot of sense at this point for me to continue to lose money through the winter. There's no way I'll be able to grow my business. So even if I only have 5 extra books, which I've kind of budgeted through here, those 5 extra books, I might be able to then start someplace else and start ramping up like this everywhere I go. So this is the model that I have created, again, because I have to make some corrections to the spreadsheet. It might look a little different because I have to correct some of the formulas, but that is what we will be looking at. So now let's go back to our presentation. So again, you have to have enough stock so you don't run out. So if I'm going to sell 5 units, I'm probably going to buy the 10 the first time. So I always have a few extra as I go forward each month. Many bills are due on the 1st. So you need to make sure you have that money by the 1st of the month. And I'm going to have that money to start out. Now, looking at what I have there, if I move into January, I probably won't have the money I need. Your cash short or extra can be negative, but not the balance in the spreadsheet that you create. And if it's as negative as mine is, that's probably not a good business model. And your investment repayments, whether they're monthly or annual, you have to put them in your spreadsheet. And so even if you're going to pay them after the end of 2 years, you probably want to be putting that money aside either on a monthly or annual basis to make sure that you have that money to pay them at the end. And I found some interesting looking airplanes when I was on the internet the other day. So this is the Grumman X-29. So next up will be Finance 2, Tracking Profits and Cash Flow. Thank you. And always, if you have any questions, be sure to reach out to me.